Howdy everyone, this episode is brought to you by Fireblocks. Love this company. You'll be hearing all about them from me later in the episode, but now on with the show. All right everyone, welcome back to another episode of On the Margin. Today I'm joined by Mr. Jurrien PlanB of Fidelity and PlanB. Gentlemen, welcome to the show.
Nice to see you, Mike, and PlanB.
Thanks for having me. It's a great. I'm looking forward to it.
We've got a lot of really interesting stuff to get into today, so I just want to dive into it. Jurrien, I'm going to share my screen here. You literally put together the best charts, certainly on Twitter that I see, and I'm going to be kind of referring to them here as we go through this episode. But I want to kind of start off with what your thoughts are on financial conditions, the Fed's tightening cycle, and just what global central banks are doing in general. So, Jurrien, you kind of kicked off this last newsletter that you sent to me before this with just your own thoughts about where we are in terms of the tightening cycle and kind of the narrative that is forming around interest rates. So you just walk us through kind of what's on this chart and what your view is on the Fed and central banks globally.
Sure, and it's all very nice to see you both and to have this conversation with you. I'm very excited to be here. But so this is an interesting Fed cycle, or it's turning into one, because I think a year ago we all knew that the pandemic would run its course and the economy would kind of return to normal, and that the 0% Fed policy, not only for the Fed but around the world, would no longer be justified, and certainly the 120 billion in asset purchases per month would no longer be justified. But at that point, the expected curve for the Fed to normalize policy was very gradual, very smooth. And basically, if you looked at the euro-dollar curve or the Fed funds curve, or even in this chart here where you see the number of expected rate hikes by various points in time for this year, the curve was very smooth back then, a very gradual return to normal, which would be around 2.5%, which is where the median dot is for the long-term view of the Fed. Or if you take R star, the natural rate, which I think is around 0.5% or so, you add 2% inflation, you get to 2.5. So a year ago, that was the curve. Obviously, a lot has changed. Inflation has proven to be a lot more stubborn and hot than I think a lot of people expected, certainly at the Fed, but I think generally in the marketplace as well. And of course, we got last week's number coming in hot again at 7.5%. And so since the December period, when we got the minutes from the previous FOMC meeting, and then the December meeting, and then various further speeches by the Fed, the path has been accelerated quite aggressively, and now actually the expectation is that there'll be 6.5 rate hikes this year. Obviously, it'll be 6 or 7, but that's what the market is pricing in, and so that kind of takes us out of the kind of the 2015 to 18 analog, which is what I had been looking at in terms of a gradual, smooth return to normal without any real urgency. And now there clearly is more urgency to that. But what's interesting to me is that, and you can see that in this chart, that as successful as the Fed has been at moving expectations in the market and giving that sense of urgency that, we need to do this sooner, faster, the market is still pricing the end point of this cycle at around 2.25%, 2% in a couple of years. So even as the curve of expected rate hikes has moved forward, the endpoint has not. And I think that's kind of a riddle in the markets at this point, because when we take, for instance, the 1994 cycle, which I think is becoming more and more relevant, and that was a long time ago, but back in the 90s, it was the Greenspan Fed, and Alan Greenspan, the maestro, as he was called, would love to kind of troll the markets in a way by raising rates when it wasn't expected, or raising them by more than 25 basis points. And so in this chart here, you can see the red and blue line in the upper left. Those were the Eurodollar curves back in December of 93, before the surprise rate hike started, and at the end of the rate hiking cycle, which was in February 95. And you can see that those curves were upwardly sloping in both cases. And even at the end of a 300 basis point cycle, which of course the market didn't know it was the end until until that became clear later. But even when the Fed was done, the market was still pricing in another 130 basis points or so of tightening. Contrast that to now. Again, like I said earlier, a year ago or even 9 months ago, the expectations were for a very gradual return to normal. So that's the blue line on the right-hand side of the chart. And now we have the red line, which is a very rapid return to not even quite neutral, but close to neutral, and then basically nothing or even a Fed easing. And I think the way to look at how the market, could thread this needle is that I think the benign interpretation is that the market concludes that the Fed is making the markets do all the hard work for it by setting expectations and jawboning the markets, and that the hard part will be done by the markets. Financial conditions are already tightening. The 2-year notes as we speak is 157. The 5-year notes almost 2%. The 10 years at 204. So the market is doing a lot of the heavy lifting for the Fed, and I think the glass half full interpretation, therefore, would be that the Fed really just has to do a lot of talking, but if the markets are doing the work for it, when in a year or two from now, the Fed won't really have to go much above 2. The alternative interpretation, of course, is more of a glass, half empty view, which is that the market thinks the Fed is going to have to chase inflation until it breaks something, and then we get a 2018 scenario during which the market, of course, fell 20% fairly quickly, and that forced the Fed to pivot to a more dovish outlook. My guess is that it's going to be the former and not the latter, but it certainly is a conundrum that even with all the hot inflation numbers and all the talk from the Fed about more, faster, sooner, that the market still expects this hiking cycle to end below neutral. Even if inflation comes back down to 3 or 4%, which I think is likely over the next couple of years, the Fed would not even end this cycle at a neutral point. And that seems inconsistent with the kind of inflation numbers that we're seeing.
And I really love this chart because it sort of has the time period of my entire career on it. It's 1992 is about the period that I started college, and 1998, the first crisis there, was the time I started working. So I vividly remember all these periods in time, and especially the rate movement. So what I like about this chart is that you see the 3 crises so very well in the chart. So the 2000 internet bubble, and the Fed had to accommodate that by lowering the interest rates, of course, which and it's much lower than the actual 10 years rate. It's also a short maturity rate, of course, but you can obviously see the difference between the Fed rate and the 10-year rate being very high after that 2000 internet bubble. And the same happened after the global financial crisis in 2008, where rates dropped again to almost zero. And then right now, after March 2020, they dropped again. And but it's a kind of a dual thing, because after each crash, so for example, look at the global financial crisis in 2008. They bring the Fed rate down, but it's also after a period where they try to raise the interest rates again. So in 2004 to 6, you see, they try to raise the interest rate, then something happens. In this case, the global financial crisis, and they have to bring the rates back. And you see that in this period as well, around 2020. So they were talking about raising the interest rates and going back to normal, and they really wanted to do that, of course, but they didn't. They didn't succeed, because the next crisis was already there, and then they had to drop them again. So it will be very interesting to see what happens when they actually increase the rates, and I think they will. but I agree with Jurrien that they of course hope that they can do a lot with talking alone and not raising the interest rates, because it has a lot of negative impact on valuation, on equities, on the wealth effect of equities, but also on other assets like Bitcoin. So, very interesting what's going to happen, and I think the market recognizes that the interest rates cannot be hiked to say 3, 4, 5% to say levels that we saw in the early 2000 or late 1990s. I think nobody believes that is possible. So they can hike the rates a little bit. Maybe it's more symbolic than anything, and of course it will have some effect on the asset valuations. But the last thing they want is to crash the stock market, so they'll be very, very sensitive to that. And it would surprise me if they would hike further than let's say the 2-3%. That would really also break the long-term trend, of course, that we see in both the short duration and long duration interest rates, which has been a downward trend since early 1990, since the early 80s, and I don't think that trend will be broken. In fact, I think Jurrien thinks the same, but I think Japan is the perfect example here, and the population. Aging of population in Japan, in Europe, but also eventually in the US will have its impact here. So I think I agree a lot with what Jurrien is saying.
I would just add to that, and I agree that the global economy, and certainly the U.S. is a big part of that, is so financialized now and so levered to low rates that I think the market correctly sees that there's a limit to how high interest rates can go, and so eventually, if the Fed needs to decide between causing a recession and tolerating higher inflation, I mean not 7% inflation, but 3 instead of 2 or 4 instead of 2, I think the Fed will be forced to accept that. And that means that even though real rates are becoming less negative very quickly now, which is what you would expect in a tightening cycle, I think what Bitcoin and what gold also right now are saying is that at some point real rates will become more negative, not unlike what we saw in the 1940s, where during the middle of that financial repression cycle, the Fed did raise rates very slightly from 1 to 1.5, but then they kept rates there while inflation accelerated yet again. And so I think that's where the market is kind of viewing this, that 4, 5, 6%, as Plan B just said, are just not going to be possible. We're not going to have a Volcker Fed, anytime soon again, because the system is too levered to low rates for that.
Can you guys maybe help me understand what's going on and how you think about the yield curve in general, right? So to summarize, just for listeners, the Fed has a lot more control over the short end of the curve. So basically everything from Fed funds up to about the 5-year, right? They directly control Fed funds, and it kind of extends out on the curve. Less control over longer dated treasuries, right? So the 10-year, the 30-year, which is more typically set by growth expectations in general. When you're looking at the yield curve, so here I think we're looking at the spread between the 2-year and the 10-year, that kind of is the difference, right, in terms of basis points between whatever the yield of the 2-year is and the 10-year. Typically, inversions of the yield curve tend to precede recessions, right? So if we're looking at this chart, Jurrien, that you put together here, you can see the yield curve inverted in 2000, right in 2000, something's blocking me, but around 2006, and then it actually also inverted in 2020 as well. So did that predict COVID? Not really, but we did have a recession, so I'll leave that up to you. And now the yield curve is basically trending down, and folks are worried about that. So could you kind of just describe how you view the yield curve, what it says about the state of the economy, and do you see it as being a reliable predictor of recessions?
So normally I would look at the 3-month or the overnight rate to the 10-year, or you can even use the long bond, which we used to in the past, before the 10-year became kind of the long-term benchmark rather than the 30-year. And so normally it would be very, very short to very long. But when the Fed anchors short rates for as long as it has, after the financial crisis, we were at zero for 6 years until late 2015. So using the 3-month, it becomes a little bit less useful because the curve is always going to be kind of steeper than maybe what's actually going on. So this is why a lot of people, certainly in the bond market, will use the 2s to 10s curve, because the 2-year should, in theory, and it does in reality, price in what the market kind of thinks the Fed is going to do, which the Fed is usually signaling, right, through the dot plot and all that stuff. So the 2-year gives you a good handle as to where monetary policy is going. And then the 10-year, or the long bond in some cases, will tell you what the market views the outcome will be of that, right? So, like you said, Mike, the front end of the curve is completely controlled by the Fed, and the 2-year is not completely controlled, but it's induced, right? Because if you think about the term structure of interest rates, they're all just a number of forward curves, right? So the 2-year is the 1 year plus what's expected after that, and so the 2s to 10s will give you a decent sense of what the market is saying about the Fed. And as you can see in the chart, that curve has narrowed quite a bit. It's still positive, so we're not in the danger zone yet, right? So when I look at financial conditions, they've tightened, but they're still pretty loose. I look at real rates, they've become less negative, but they're still negative, at least out to 10 years. The 30-year real rate, as dictated by the TIPS market, not by the CPI, is now actually slightly positive. And then you look at what's expected. The market's expecting probably 8-9 hikes over the next 2 years. So a lot has been priced in here, and the curve is still positive, at least 2s to 10s is. So that does offer a ray of hope that the Fed is actually not going to break things during this cycle. And it's interesting that the 1994 cycle that we had just discussed, the Greenspan Fed stopped tightening right as the curve went to kind of zero, and then it backed off. So maybe even the maestro was looking at the yield curve back then. And certainly, I think the Fed today and the Fed before Chair Powell, I think they look at the yield curve very, very intently as a signal from the market, as well as financial conditions. And financial conditions, there are several indicators out there. Bloomberg has one, Goldman Sachs has a widely followed one. But it basically consists of the dollar, credit spreads, short rates, long rates, and the S&P 500. So by definition, for the Fed to get a more real-time handle on the economy, it has to look at the markets. But the markets aren't always right, and the markets can cause whipsaws, and then people, blame the Fed for essentially being, being servants to the financial markets. But they have to look at real-time indicators in some way, and the yield curve is certainly one of the biggest ones. And it's heading in the wrong direction, but again, that's what you would expect in a tightening cycle. The yield curve should, in theory, never steepen in a tightening cycle, but it has not yet reached the danger zone, which would be below zero.
There's this old saying, right, that the bond market is the singular source of truth, right, in general. And something that I've been hearing from guests that we've brought on the show recently is maybe there's some reason to think that the 10-year is not an honest signal as it used to be. And there are a couple of reasons for why that might be, right? But it's basic. Maybe you might call it manipulation, or certainly more intervention by the Fed. We had a guy, Joseph Wang, who's the co-host of Forward Guidance with my colleague Jack Farley, who kind of outlined this pretty neat idea about pre and post Great Financial Crisis, right, where you had a bunch of regulation post GFC that forced big banks to buy up treasuries, which kind of distorted the pricing signal. I'd just be very curious, when you kind of look at the bond market and let's say the US 10-year in general, do you view it as an accurate pricing signal, or is it more distorted by intervention by governments, central banks, et cetera?
I think it's more the latter. It used to be more of the former, but and also with respect to the earlier chart, I think the yield curve, of course, is an X-ray of the market. How one of the deepest markets in the world, in fact, the deepest market in the world, the interest rates markets are looking at things, and the 2-year domain, of course, is the bank domain, because banks have liabilities that are typically saving accounts in the 2-year maturity domain, and 10 to 30 years is, of course, pension funds, mortgages. So that's an entirely different group or asset looking at the market, and so the yield curve gives you all those perspective in one line over time, also dynamically. So it's great, and sometimes it goes wrong indeed when you go negative. That almost always predicts a recession. However, lately things have changed a bit. So it used to be that the market participants, the banks, the pension funds, were giving their votes, if you will, by buying bonds, and you could read in the yield curve how they thought about the future. But right now, I guess, but maybe things are different in Europe than in the US. So I'm very interested in Jurrien's perspective as well. Right now in Europe, the central bank is one of the biggest buyers. In fact, they're in the whisper to be the only buyer, the one buyer. Those are the terms that you hear. So I guess even mortgages, 50% of all the mortgages are bought by the central bank. So in that way, the central banks right now have very much control, not only over the short-term durations and their own Fed funds rates, but also over the 2-year, 10-year, and 30-year rates. So I guess if we go negative now, it's more like a little mistake or something of two departments not talking to each other. And but in the end, I guess the signal is less pure. The signal that the yield curve gives to investors is less pure now than it was before all the quantitative easing.
Yeah, I totally agree with that. And I don't think you have the chart on this, Mike, but I have a cloud chart which I can send to you. Maybe we can splice it in later.
Sure.
But that shows a scatter plot of inflation expectations through the TIPS market and nominal yields. And you can pretty clearly see how the Fed's asset purchases have created a situation of financial repression, and which last year, basically pulled the 10-year yield about 100 basis points below where it should otherwise have been. And actually, if you can pull up that bond chart that you had on before, that's a very simple bond model. It's not that one. It's the one with the green. Yeah, that one. It shows you how far below kind of my fair value band the 10-year yield got last year, right? So I have a very simple bond model that says, give me the 10-year nominal GDP rate, the Fed funds forward curve, and a demographic indicator, which in this case is the growth rate in the labor force, because demographics, I do think, drive interest rates very powerfully. And you can see this band, and the band is moving up because the Fed is tightening, and therefore the forward curve is being lifted. But we're kind of near what would be considered fair value, but a year ago we were well below it. And so I do think that shows you the financial repression of the impact of asset purchases. And Plan B just mentioned, what the ECB is doing, and earlier what Japan is doing. I think Japan is a very good example because their demographic trends are about 10 to 15 years ahead of ours in the US, and Europe is a little bit ahead of us as well. And so demographic trends, aging, baby boomers in the US at least, are a very clear deflationary force, and that whatever inflation we're getting now has to offset that deflationary force. And so, the Bank of Japan owns half the debt in Japan, and it's buying half the supply on an ongoing basis, and it has completely tamed the bond market over there. The the annualized volatility of long-term JGBs, Japanese government bonds, is 3 in Japan versus 11 here in the U.S. So it shows you where we might go in the bond market in the coming years. And if that happens against a backdrop of persistent inflation, which of course in Japan has not been the case, but in the U.S. maybe it will, then you can see how people are looking for real stores of value as a hedge against that.
Some of these statistics here are just absolutely nuts. So everyone kind of knows and has accepted some of the extreme monetary experimentation that the BOJ, right, the Bank of Japan, has kind of undertaken. Plan B, I wanted to ask you this. I didn't want to interrupt you, but did you say that the ECB is buying 50% of all mortgages in Europe? I mean,
That's correct.
That is nuts.
The same is true. Yeah, it is, and the same is true for bonds, right? Jurrien mentioned as well in Japan. I think it's the same in the U.S. that the biggest buyer, maybe 50%, I don't know in the U.S., but especially, the central bank is also buying equities, by the way. So we're going into that in the next topic, I guess. But yeah, it's a driving force, and it's a big problem. It's a very fundamental thing. There used to be a big division between the state and the central bank. But that division has become less and less because right now the government emits bonds and the central bank is buying them out of thin air, of course, and so the two are one in a way.
The Fed owns, I think, the Fed's balance sheet is 36% of GDP. The Bank of Japan's balance sheet is 128% of GDP. So if you think the Fed has already gone to extremes, you ain't seen nothing yet if you look at Japan.
Yeah, exactly that point, because in Europe is always somewhere in between. and as Jurrien said, the demographic component is very strong. And you can see that in the rates, you can see it in the balance sheet, the central bank balance sheet. It's almost like a powerful predictor of what's going to happen with rates.
This is an important component of the crypto discussion because there is an element out there that is convinced that the dollar is going to get trashed. It's going to lose its reserve currency status. And you just have to look at not only Europe, but Japan and what they've done in terms of their kind of fiscal monetary integration and how far they've gone and how stable their currencies are. And so I do think that is a cautionary tale in terms of thinking that fiat currencies are going to be nothing. Maybe because they all lose value similar in the same way, they'll be nothing. But so far, the currency side of this, I think, has probably been more stable than a lot of people expected in terms of what happened to Japan.
Yeah, I'd love to get your thoughts on just what you view almost like the real world IRL implications of some of this crazy monetary policy is. Because I think you're absolutely right in pointing out, if you look at what the BOJ has done, right, the yen is still a relatively stable currency. And, if you were to describe some of the actions that even the Fed has taken, right, to someone living 20 years ago, they might have understandably called for hyperinflation. And we haven't seen anything of that sort. But I would argue that I think there are other kind of societal implications for some of this monetary policy. If you even just look at, right, the Fed is buying up with QE an enormous amount of mortgage-backed securities, right, which is kind of supporting the housing market. That has implications for the next generation that's trying to buy their home for the first time. Just look at housing prices in the U.S. It's absolutely nuts. And I think also, I don't think you can draw a direct line to the Fed here, but certainly it seems like we're living in a bit of a wonky time politically, both domestically for me and Jurrien in the United States, but also geopolitics tends to be heating up. How much of a line do you guys draw between some of this, let's say, unprecedented or unorthodox monetary policy and kind of some of the weirdness that we're just seeing on the global stage?
Yeah. I don't think it's weird at all. It's something that we've seen over the centuries, even over millennia, because even the Romans did it, right? The debasement is a real thing, and it's a very profitable thing to do for governments because they need the money for warfare and welfare. So even the Romans, they debased their currency to the extent that the silver content of the denarius was 90%, and it dropped to 10%. Even to the level that the Roman soldier said, "We don't pay us in denarius, pay us in gold or homes or land, but you keep your fiat. And
Right.
and so we're seeing that right now again, and since 1971, in an accelerated fashion, that the central banks are basically creating money out of thin air. It's not a secret, and helping governments doing their thing, and that distorts asset prices, house prices, stock prices, Bitcoin prices, everything, and so the fact that we're seeing it is not weird. I think it's a normal thing, but it's weird to think about it because we also know where it ends, right? Or at least where it ended all these past times. So it's a very interesting time to be alive.
Yeah, no, I agree with that. And, whether what the Fed is doing is the cause for all of the craziness that we're seeing, or whether it's just a symptom of it, and that, we were heading in that direction anyway. I don't think anyone of us knows in real time. But clearly the policy response gets more and more severe with every cycle, or so it seems. And the question is, what would have happened if there was no policy response? And then obviously, the Fed is trying to moderate the boom-bust cycle, which, if you go back and look at U.S. economic history back before the 1900s, when it was more of an agricultural economy, you were always in a boom-bust mode. You either had, a massive boom or a deflationary bust, and the cycles were about 2 years long, and it was always up and down and up and down. And then, after the Great Depression, of course, and as the economy became more of a service economy and less of a cyclical manufacturing or agricultural economy, the cycles got smoother, and now we have a recession not even every 10 years on average. But the question is, what are the unintended or intended consequences of that? And obviously the financialization of the global economy, especially the U.S. economy, makes interest rates kind of the master that ultimately decides the fate. It's the stock market as well, of course, via the wealth effect. And it's interesting, we were talking about kind of the mispricing of bonds before. There's a direct channel from there to equity valuation. And you and I may have had this conversation in the past, looking at the discounted cash flow model and what the discount rate has as an effect on it. And the discounted cash flow model is great because you can explain literally everything through that model. It's also terrible because there are so many variables that you can never really solve for anything because there's so many moving parts. It's like four-dimensional chess, But if you isolate certain variables, right? So you have cash flows in the numerator and the discount rate in the denominator of the formula. But in the denominator, the discount rate is the risk-free rate, the 10-year yield, and the equity risk premium. And the equity risk premium historically has been around 4%. Today it's around 3%. But the risk-free rate, of course, is a very important variable because that's the bond yield, and that feeds right into this model. And a year ago, when the 10-year Treasury was 100 basis points too low, and you can see it on this chart here, that's a difference between where the 10-year is trading and where it should be trading, at least according to my models. That's the horizontal. And on the vertical, you see the difference in what the DCF says the equity market should be priced at and what it is priced at. And you can see that the line goes from upper left to lower right. And a year ago, when the 10-year yield was clearly repressed by QE, the market was 6 points too high in terms of its PE. That is being actually reset very rapidly now. And so at this point, with the 10-year going from sub 1% to now above 2%, that valuation gap, that asset price inflation, which we can clearly quantify here, has almost been corrected. And so I think that actually makes me more optimistic that a lot of the reset that needs to happen in the stock market because of the changing nature of the liquidity cycle that's now underway, that a lot of that damage actually already has been done. So anyway, that's just my take on that.
So I'd love to get your both your thoughts on Plan B. Maybe I'll just pick on you here, just in terms of almost sentiment right now. So we're looking at put-call ratio, which kind of suggests that we might be, nearing a sentiment low. I don't have this chart. I wonder if we can pull it up here. But there was a chart going around that sentiment was even worse a couple weeks ago than in March of 2020. So people were like really panicking. And then I love this chart just of insider buying kind of picking up. So I guess Plan B, I'll kind of pick on you here and say, combining these two charts with what Jurrien was saying about fair value for the stocks right now. I mean, do you think that we've still got lower to go? Do you think that the hiking cycle has been kind of priced in, right? Obviously, some of these, we had a chart on meme stocks here, which have gotten absolutely walloped. So do you kind of think that we've still got lower to go here, or some of the pain has already been priced in, so to speak?
Well, to be honest, I don't have an outlook for equities. So I guess it all depends on what the interest is going to do. If the interest is going to be raised more than the market expects, and we saw from earlier charts, the market does not expect a very high interest rate, let's say higher than 2-3%. But if the Fed does go there, that will be dramatic for stock market. But yeah, well, I guess together with the market, I don't think they go there. So that could very well, that aligns basically with what Jurrien is saying about we've seen the worst maybe yet, because all the rate hikes that are that we talk about and that the Fed is talking about, those are expected by the market, those are priced in already. So only the difference between what's going to happen and what's not expected and what is expected is going to have an effect on the price. With regard to the put-call parity, I really like derivatives markets. There's a lot going on there. I like that chart that you showed, that one. Because what you see, there's a lot of things going on there. And what you see is that there's a lot more calls than puts in bull markets. And it sort of is investor sentiment. And of course, the calls and the puts, from a professional perspective, are delta neutral. So those are volatility trades. They should not reflect anything regarding the level of the stock market in this case. So what we're seeing here is just the volatility, or the two markets, the two sides of every market, the calls and the puts that are bidding up the prices or bidding them down. So for example, and you see that in Bitcoin even to a more extreme, but in bull markets, there's a lot of leverage longs. And the other side of the trade, of course, are the cash and carry traders. So they
right.
and that creates some very high open interest, very high contract volumes. And of course, if the bull market is over, then a lot of the traders don't dare to trade with a lot of leverage anymore, and that all goes away, including the cash and carry trade, and we can see that very clearly in the Bitcoin market. But in this chart, it's also very clear from the three dips, right, in the middle of the chart. And I think if we're talking about leading and lagging indicators, then the derivatives markets is one of the more interesting things to look at, because they might be a little faster because of all the arbitrages than the just plain spot markets of equities and bonds.
I've got one more question on equities here before we move on to Bitcoin in general. But Jurrien, you've got some pretty interesting thoughts here on earnings in general. And if I remember the last time that we chatted, when we kind of went more in depth about your kind of DCF approach for looking at the market, there are kind of two different things to take into account when you're looking at equities valuations, which is the valuation, the multiples that equities get, and then the earnings, right, that equities are producing in general. What seems like is going to happen, right? And you tell me if I'm incorrect here, but as rates go up, kind of that description that you were giving before about the relationship between valuations and rates, we should see compression in terms of multiples that equities are getting. So then it really becomes earnings' job to kind of carry the stock market in general. So if you could kind of walk us through, A, was that correct? A correct summary kind of your thoughts here, and then B, what do you expect earnings to do in 2022, or what are we looking at with this chart here?
Yeah, no, I think that's exactly correct, and I think it's important to to understand that the market can correct. So valuation ultimately is what matters, right? Price is just price. And the same is true for Bitcoin, by the way. Like, that's why it's so important to have valuation models, because the price is just that. And so, so per our what we were just talking about, the Fed's financial repression last year caused the PE to go up 6 points higher than, in my view, what it otherwise should have been. Off of a base of a 20 PE, that's a 25% asset price inflation. People call it a bubble, a Fed-induced bubble. I don't think 25% is a bubble, but it's certainly a significant increase in valuation that you can attribute just from the interest rate change, right? Not even from the earnings side. And so as that has now come out, because the liquidity tide's going back out to sea, and we see that the PE on the S&P 500 based on this year or next year's earnings is already down over 4 points. So we're not quite there, but we're almost there. But that doesn't mean that. So if the PE is 25% too high, which means that it would have to come down 20% from the high to correct itself, that doesn't mean the market has to go down 20%. It just means the PE has to come down 20%. So last year, earnings growth was 50%. If we go to the next slide, which is the calendar year outlook, 50% earnings growth will cover a lot of sins, right? Because you can have a multiple reset, but if the earnings number is so strong, you won't feel it in the markets. And so for this year, for 2022, with earnings growth clearly slowing, and right now the consensus expectation is for 7% growth, which is down from the beginning of the year, which was at 8.7% growth. But 7% is still okay. But again, if the PE comes down 20% and earnings go up, let's say 10, that has different implications for price than if the PE was coming down 20%. And there was no earnings growth. Then it would be a 20% price cut as opposed to maybe a 10 or 12% price cut. And that's, by the way, 12% is what we've already seen, right? And actually, you had the meme stock chart up earlier. But one thing that I think some people are missing is that even though the S&P is only very recently in a correction, I think the high was January 4th, and we're now mid-February. Really, the rotation, the churn, the correction in the kind of the frothy part of the stock market has been going on for over a year now, right? So this is the Goldman Sachs Retail Favorite Index, which I think is a reasonable proxy for the meme stocks. They peaked in like February of 2021. They're down about 35% at the recent lows. They're up a little bit from there, but those are the stocks that have little to no earnings or earnings stability, and therefore are very much influenced by the liquidity tide, which was coming in hard, of course, over the last 2 years between the fiscal and the monetary side. That tide is back out to sea, right? The Build Back Better is kind of languishing in Washington. The Fed is now obviously taking the punch bowl away. And so these would be the stocks that you would expect to falter in that environment. And that's exactly what's happened. And it's been happening for about a year. So this correction in the stock market is much longer in the tooth than I think people might conclude if they just look at the S&P 500.
Something that you said resonated with me, which is maybe we saw kind of peak meme stock mania back in February of last year. I think you can make a pretty strong argument that you saw retail leave the crypto market back in about April of 2021 as well. So what we're looking at here is just a chart of Bitcoin starting in August of 2020. Plan B, since this is maybe more your area especially, I'd love to just get your thoughts on where you see Bitcoin going in 2022 in general. I kind of want to ask you about this idea of like the super cycle. Do you believe that we've abandoned 4-year cycles in general? What are your just kind of thoughts on Bitcoin over the past year and kind of moving forward?
Yeah, well, I think you described it very well. There's basically two scenarios. One is the meme stock scenario, and in low interest rates environments that we have had, a lot of money will be misallocated to maybe not so good investments, meme stocks. And I'm quite sure that institutional investors who are, well, at least in Europe and at least the ones I know, not very fond of Bitcoin, not very known to Bitcoin as well. I know for Fidelity that's very, very different. It's like the white raven out there. But a lot of institutional investors see Bitcoin as a tech stock and maybe even a meme stock. So one of the candidates that will go down when interest rates go up. And this misallocation of capital into the funny stocks unwinds. So that's one scenario. The other scenario is, of course, well, Bitcoin is a more like a commodity or a currency even with a yield curve or an interest rates at least not that far out as the US dollar, but at least 1 year out. And a Sharpe ratio of, at least higher than 1, which is very unique for Bitcoin. It has very high volatility, but the upside potential is even higher. So it makes a very crazy investment, actually. One that has not, it's the only one out there with return above volatility. And I think there is also an arbitrage relationship there with interest rates and with currencies that and we didn't talk about that, but we talked about the link between the rates, the interest rates, the bonds, and the equity market. We didn't, but there's also a very tight link, maybe even tighter, because it's a direct arbitrage and it's also mathematical between foreign exchange and interest rates. So, for example, the 1 year interest rates in Europe is minus 25 basis points. The 1 year rate in the US is 1.25, I guess. So that's 150 basis points between them. If the US is going to raise interest rates and Europe is not, that makes the dollar more interesting, more attractive, and money will flow to the dollar will get stronger. And there's a very direct arbitrage relationship with futures, of course. You can buy dollars or sell euros right now or 1 year ahead and capture that spread. And if you look at Bitcoin as a currency, you can do the exact same thing through the exact same mechanism, namely the futures. So you can lock in, and currently it's low, but you can lock in like 8, 9, 10% in futures contango premium with and finance that with negative yielding euros, for example. And I think maybe I'm so much focused on it because I'm in Europe and the rates are negative. So, but yeah, I see Bitcoin as a unique asset with a asymmetric upside, a positive Sharpe ratio, and a direct arbitrage with fiat currencies. So that is the total opposite than a meme stock. Those are the two extreme scenarios. And of course, I think the latter we'll see the latter, and not the meme stock scenario. But that will be the interesting thing to watch in the, next couple of months.
This episode is brought to you by Fireblocks. I talked to a lot of fast-growing crypto-native funds, crypto banks, exchanges, and the like, and they all tell me they have the same two problems. One, their treasury management setup sucks. They've got analysts wasting time and money on manual transactions. Two, they are not happy with their current security setup. They're sharing passwords, they're sending test transactions, and they're worried that their funds might be at risk. Fireblocks is a platform that solves all of that for you. They are a one-stop shop portal which automatically plugs into exchanges, trading venues, etc. They source deep liquidity and solve everything from day-to-day crypto transactions all the way down to complex DeFi strategy. And the best thing about Fireblocks is that they offer scalable solutions with industry-leading technology. Doesn't matter if you're a 2-person crypto fund or a 2,000-person crypto exchange, these guys have you covered. And the last thing that I'll say about this company is that I have known them for years. They are a high-integrity team. They ship product like no other. I would trust them with my own funds. So, click the link at the bottom of this page and tell them that I sent you. Very, very important that you click the link at the bottom here. Otherwise, they're not going to know that I sent you, and then how am I going to get credit? So help a brother out. Click the link at the bottom of this episode. Tell them I sent you. I'd love to get both of your thoughts here, just in terms of how you think about valuing Bitcoin in general. Right? I think, and PlanB, maybe I'll actually pick on you again to give your thoughts on kind of stock to flow in general. But there are a couple of methodologies, right, that I've heard people use to value Bitcoin. One is stock to flow, which PlanB, I know you've done a great job in kind of getting out there. The other is kind of Metcalfe's law, or some variation on Metcalfe's law, looking at the network value of Bitcoin. How do you guys think about valuing Bitcoin or putting some sort of valuation methodology around Bitcoin?
Well, it's very important. I think for every investor, especially the professional investors, you have to have some framework for valuation. And for equities, that's the discounted cash flow model that Jurrien talked about. For foreign exchanges, it's the arbitrage model with the interest rates, etc., etc. So you need a fundamental model, and maybe to start, it's a good thing to reiterate that indeed it's about valuation. It's about a model, a theoretical value. It's not about price. So of course the price has to it's above and below the valuation line, and that's okay. But the valuation is something different than price. So valuation is very important, and basically, if I simplify it totally, you can use a lot of things to value Bitcoin. You can use indeed the non-zero addresses. You can use the transaction volume or the UTXO volume or the hash rate to make the link with the miners, or you can use the stock to flow ratio, or you can just use time as an adoption variable.
Yep.
And basically, they all show you one thing: that the price goes up and to the right, and then it becomes more of a personal taste, I guess, which one you would pick. You can go very mathematical with it. You can go. You can do an econometric discussion about which model fits better, or which model has co-integration, or is not overfitted, etc., etc. Or you can do a very fundamental perspective on it, and that's what I did with the stock to flow, of course. So what I like is, like the capital asset pricing model, it's just very plain. Capital asset pricing model says the more volatile an asset, the higher its returns. And the stock to flow model says the scarcer the asset, the higher the market cap should be. And in that case, maybe, it can be used as a very rough valuation model, certainly not as a short-term trading model. And as we all know, the model is indicating $100,000 valuation of Bitcoin for last year, this year, and 2023. In fact, for the entire 4-year periods, and of course the price has been much below that. So the question now is the model invalid? Do we have to refit the model, or will the next 2 years of this cycle be above that model valuation line? Say, for example, 150,000, which is only a 3x or a little bit more than we are today, and we can do that in 2, 3, 4 months. So and then it's in an entirely different world. But right now it's kind of very interesting what's going to happen, and let's see what's going to happen.
I just want to give my respect to PlanB, because I only fell down the Bitcoin rabbit hole 15, 16 months ago. And, I followed, obviously, the whole Bitcoin story. I go to Burning Man. All my burner friends were always talking about Bitcoin back years ago. But it was always kind of a sideshow until, it goes up enough that everyone starts to ask questions. And obviously, as a person with a public role at Fidelity, I need to have, I concluded I better start coming up with an answer. And the only way to do that is to go deep and to do, what Michael Saylor says is you got to put in the hours. Otherwise, you're not going to understand it, and you're not going to have the conviction to hodl when it goes against you, because you're gonna puke them out like people do with the meme stocks, because they don't know enough. And so my first step was just to kind of recreate or re-understand the narrative. And literally the first thing I did was to look up the stock to flow model and learn about PlanB's model, and unfortunately, it's all out there to be seen. It's open source, and that was kind of my first, as a math nerd, as an analyst, I need to have numbers. I can't just do it because it feels right. And so that was my first, jump down the rabbit hole, was to essentially reverse engineer the stock to flow, not to make a different version of it, but just to understand the math. And then, I said, okay, there's something really great here. I mean, obviously stock to flow has perfectly explained, or has very well explained, Bitcoin's evolution or revolution, I would say, over the past 10 years. But then I'm like, okay, there's got to be more, right? I mean, something can be scarce, but if it doesn't have value, it doesn't matter how scarce it is, right? And so obviously Bitcoin has a value, because otherwise stock to flow would have not worked for a number of years already. So I quickly got to the demand side, and I've studied S curves in the past. I've looked at kind of China's emergence as a global economy by studying S curves in the past. And so I quickly went down that path, and I kind of, actually, if we go to the previous chart that shows the addresses, you can do a pretty simple math. I mean, that smooth line is just a simple power regression in Excel. Like it's nothing fancy, right? And it explains, as Plan B said, the time series for adoption. And then I added, and I think we have the chart somewhere, but I added mobile phone subscription growth, in whatever that was, the 80s or 90s, internet adoption as well. And it's funny because when I posted my demand model, over a year ago, so the pink line is the mobile phone S-curve model, and the purple line is the internet adoption S-curve model. But I got all the Bitcoin maxis gave me so much grief for using mobile phones. I'm like, this is nothing like mobile phones. And I'm like, that's not the point, dummy.
That's not the point. Yeah.
The S-curve, It's about exponentially growing networks. And then Metcalfe's law, of course, as we know, states that, as your network grows, your valuation grows exponentially even to that. Like the growth, the network is already growing exponentially. So the price or the value grows double exponentially, right? So if we go to the Apple chart, so I'm like, okay, well, give me, I wanted to learn more about some specific examples. And so I decided to look at Apple. I'm not a security analyst. I don't know Apple stock from any other stock, but obviously Apple is a dominant player, has a massive network effect. Actually, let's go to the other one, the one that precedes it. And what you see is a very simple, analog here, right? So this shows in the orange line Apple's 12 months trailing sales, which to me is a very crude approximation of its network, right? As its network grows, its revenue should be growing alongside with it. And since its low in 1996, the network has grown 53-fold. But the market cap has grown 1,700-fold, right? So the market cap is a multiple of the network growth. So if we go to the next chart, showing that just in a different way, you can see, so what I've done here is I've indexed the price to sales ratio to Apple's stock price back in 1996. And what you can see is that from that point, the price is up 1,500 times, but the price to sales ratio, which is the valuation metric, is up 30 times. And so everything is an exponent of everything else. And I think that's kind of generally what the skeptics of Bitcoin maybe miss. And so if we go to the next slide, I've applied that same logic to Bitcoin. And to me, the valuation metric that I like the most is just very simple, the price to network ratio, right? So the price divided by millions of addresses. It's really that simple. And you can see that indexed to the price in 2010 or 11, I forget. The price to network ratio is up 867x, and the price is up 640,000x. And I don't know if this is a literal interpretation of Metcalfe's law, but it's my creative license. But if you just do a square of the 867x, you get to something resembling the 640,000x. And so to me, this is a way of having an anchor a valuation anchor, like Plan B said, so that you actually have something to compare the price to. Right, and so in the next chart, I've compared Apple and Bitcoin side by side, and you can see they're not the same thing. Of course, one is a stock, one is a commodity currency, which I think is a very good way of labeling it. But you can see that they followed the same kind of evolution, and so for me, what matters is that curve going up and to the right, as Plan B said. And if we go to the next chart, you can see that if the network effect keeps evolving like it has during past S curves, then it is going up and to the right. And I'm not here to make any price predictions. That's gotten me into trouble in the past. But you can see that demand curve, unless something breaks with Bitcoin, which I think it's probably too late for, right? It's too big. I don't think anyone, at least in the major countries, intends to outlaw it or anything like that. Maybe they put some guardrails around stable coins, whatever. But I'm not seeing anything that says there's going to be, that the regulators are going to completely kill this. And at this point, it has critical mass. It has that first mover advantage. So if the demand side, the network effect keeps going up and to the right, then really all that matters for me as an investor is where is that price now versus where that curve is going. And if the price is at 44 and the curve is going to 100, and actually the Plan B, my kind of price level, not a target, but the price level that would correspond with where this network effect is likely to go is around 100,000 in 2023. So our numbers are exactly the same in that sense. And then it's just a question of, if it's 50, then that's a bargain. It's cheap. If it's 150, it's expensive. And I'm not here to buy and sell Bitcoin. I'm a long-term investor, but that's how I come up with a valuation framework, and whether Bitcoin does or does not have value at this point. I mean, it has value, but whether it's overpriced or underpriced relative to that value.
Yeah, I love the analysis, by the way. It's a great example of how you can use laws like the Metcalfe law and earlier innovations like the mobile phone and the internet, and project that with some creative touch, of course, to a new invention. And I'd love to see. I love the analysis. I also love that, by the way, that Fidelity does it as one of the biggest asset managers in the world, which should signal to most investors to take the asset serious, because. And the other thing is, I really like it to be open source as well, so we can replicate it, we can discuss it, because there's a lot of hedge funds, of course, also doing these kinds of analysis, but they're not publishing about it. They're sort of keeping it proprietary. And I think what we need at the moment is discussions like we're having right now, and analysis like the chart before us, and talk about this innovation, this asset, this investment, and where it's going. So yeah, I really love to see more of this this kind of analysis.
Me as well.
That's great.
Thank you.
Me as well, guys. I've got just a couple closing questions here for the two of you. I know we want to stay away from price predictions and everything, but I'd love to just get your thoughts on kind of this idea of the 4-year cycle, super cycle, Bitcoin halving, et cetera. Right. So in the past, I mean, the crypto market has kind of followed these very let's say predictable kind of 4-year boom bust cycles. They're anchored around the Bitcoin halving, right? And the supply shock kind of leads to a run up in Bitcoin prices, and then a whole bunch of altcoins follow. There's a bear market that proceeds for the next 2 years, et cetera. I think Su Zhu, who's the leader of Three Arrows Capital, was kind of the first guy to propose this alternative way of looking at it, which is basically that can't go on super predictably forever, right? This asset class is either going to make it or it's not going to make it. And that was when he coined the term super cycle. And I think you could make a pretty strong argument that we're actually in the super cycle right now, although this is not what anyone thought it would probably look like. It wasn't their dream version of the super cycle, which is basically that you're just seeing a departure from how crypto has behaved in the past. And I think that makes a lot of sense just from a first principle standpoint. You have a more institutional holder base, you have more sophisticated investors. There are more types of assets that you can buy outside of just Bitcoin, and Bitcoin is a relatively smaller part of the market for crypto than it's been in the past. So I'd love to just get your both your thoughts on kind of a market cycle standpoint? Do you think we still are in these sort of 4-year cycles? Is the halving as important as it used to be? Or what's your kind of thought process for what we should expect in 2022, staying away from specific price predictions?
Yeah, well, I think the halving cycle is still very much alive. At least it was alive last time, right? Mm-hmm. In 2020, because there was one party talking about the halving cycle and stock to flow and price increase. But there was also a very large group on the other side that talked about the death spiral and the hash rate going down and Bitcoin going to zero and Bitcoin was dead, basically. And we've seen that same discussion in all 3 past halvings. And I'm quite sure we'll see that same discussion pop up again in the 2024 halving. So as long if there is 2 views fighting each other, I think it's still there. Personally, I think the halving cycle will be there until we beat real estate stock to flow. So maybe 1 or 2 more times, but indeed it cannot go on forever. And I like the super cycle theory or scenario because it gives you a scenario with a thought that's very reasonable. And I like thinking in scenarios. So the halving is one scenario, the super cycle is another scenario. Maybe there's even there will be more scenarios. But for me as a quant or analyst, nerd also, but I have to see it in the data. I have to see the super cycle in the data, and right now I'm not seeing it yet, and that's okay. So we have to track that. But for example, volatility. One of the things that's within the super cycle theory or view is that volatility must go down. And we've seen the last couple of months that we dropped 50%. Twice last year, so I guess volatility is here to stay, at least for a couple more years, and it's also what makes the Bitcoin asset so unique at the moment. The very, very high volatility and accompanying return as well, the Sharpe ratio of 1. So in my view, it's that particular aspect that the high volatility is not going away soon, and so that it's difficult to reconcile that with the supercycle theory. But anyway, we'll see. It's very interesting.
Yeah, from my perspective, I guess it's a matter of semantics, but to me, supercycle is the secular trend, and I of course think about that more in the space of equities and fixed income, and then the cycle, the part. It would be like the halving cycle, right? That's the 4-year cycle. We've used to have that in the stock market as well. But Plan B, you made some great points. I do think the volatility is a feature and not a bug, and it's a feature that will stay with Bitcoin just because it's so perfectly price inelastic, I guess, or price elastic. I can't remember which one it is. But if there's never going to be a supply response to an increase in demand, then you're going to have volatility, right? So in commodities, if too many people are using oil, guess what? Some oil is going to get pumped somewhere, and you got to get a supply response. Or if there's too much demand for copper mines are going to open up, maybe with a lag. For gold, that is less so, of course, because it is a harder to mine commodity, which is why gold has a high stock to flow as well. But the Sharpe ratio, I think it's 1.25. So over the last 10, 11 years, the return is 270%. The vol is 200%, which are, of course, astronomical numbers, but they cancel each other out and still leave a very good Sharpe ratio. Although the traditional finance person in me will point out that a 60-40 index has a Sharpe ratio that's the same as Bitcoin. It's just that the numerator and the denominator are just orders of magnitude higher on both sides. But anyway, obviously Bitcoin is in a super cycle. That's the whole history of Bitcoin has been a super cycle, and whether that continues or not, my guess is that it is based on Metcalfe's law and the S curves and the stock to flow. But what I think is the most interesting thing in terms of the coming years is that when I curve fit or regress stock to flow to price over the past 11 years or so, and I do the same with these S curves. Obviously, by definition, because that's what curve fitting is you explain very well what the price has done, and it's been of course in sample. Although I've tested, and I don't know, PlanB, you've probably done the same, but I've tested your model or my interpretation of your model by using it all in sample until now, or starting the out of sample period 5 years ago, and they have both equal validity as an explainer of what has happened, and that to me makes the stock to flow actually a very robust model. But I will say that the S curve model over time starts to flatten out from here, whereas the stock to flow model continues to go up in a straight line, or on a log scale in a straight line, which would be an exponential line on an arithmetic scale. But we're now at the point where those two models are starting to part ways. And the next and last time that the two models intersect is in 2023 at what would be an equivalent price of about 100,000, which is why that's the number I've been using, because that's when the models meet for the last time, right? Because the stock to flow spikes and then it goes flat for a couple of years, and that's when the two models intersect. And from that point on, the stock to flow just keeps going up and to the right, and the demand model goes up and to the right as well, but at a slower slope. So that's kind of how I think about the super cycle versus kind of the shorter cycle.
What I'd love to end on here, just to set a little bit of context as well for Bitcoin's role on how you see Bitcoin's role on, let's say, the global stage over the course of the next 10 years. So, I want to just caveat by saying I'm not a geopolitical strategist, whatsoever, but I certainly notice things that are going on in the world. And it seems like we're probably at a point of peak uncertainty, let's say within the last 20 years or so, right? So we're recording this on February 15th. There's a lot of consternation right now about budding conflict between Russia and Ukraine. I'm not sure if you guys noticed, but Russia and China just signed a 30-year gas deal, pipeline between them that's going to be settled in euros, right? There's a lot of consternation. So yesterday, on February 14th, Justin Trudeau invoked the Emergencies Act in Canada to kind of deal with the Freedom Convoy protests, and also announced increased regulation on crowdfunding platforms and crypto-related platforms. And all of it just kind of, to me, suggests governments being very, very worried and maybe clamping down a little bit on their citizenry. I think the argument for maybe against Bitcoin is that Bitcoin represents a way to get around a big tool of control for governments, which is the influence that they have over their financial system in general. And there's an idea that governments aren't really going to like this idea that people can just have non-sovereign money, kind of a free-flowing system of cash between countries. So I'd love to just get your thoughts, if any, on the current geopolitical situation as you see it, and what, if any, role Bitcoin has, on the global stage, let's say over the course of the next 10 years or so.
Well, whatever the future may bring, Bitcoin certainly did enter the geopolitical scene, right? It's and it has come a long way, because it has come from a cryptographic programmer's toy, basically, to a collectible that has some value to an asset that even institutional investors take serious, like Fidelity. And companies use on their treasury accounts as money, like MicroStrategy. And right now we have seen, of course, the first country adopted El Salvador, which is a very small country, but certainly if that has some follow up by bigger countries like Mexico, Brazil, or I don't think Turkey, but some bigger country would be opening the entire geopolitical discussion that was opened, pioneered by El Salvador. And maybe, I like to think in phases. Those are the phases, I think. Yeah, and I think this is a very important phase, a make or break phase. And I agree with Jurrien that Bitcoin is too big, and governments will not choose to ban it, but to regulate it and to tax it. That's at least what we're seeing right now.
PlanB, I'm sorry to interrupt you.
Yeah?
That's just such a cool analogy that you have with the phases. Would you mind just briefly explaining the phase analogy for the listeners?
Yeah, phase transition is something from physics. The same thing can be different things. Yeah, well, that sounds funny, but for example, water can be fluid, it can be ice, it can be vapor. Just when it passes a threshold, the temperature, it would go into a different phase. And you see that in a lot of things. In fact, the dollar also switched phase in 1971 when it was before that it was coupled to gold. After that, it was not. It was just floating around in fiat. So Bitcoin also has these phases where it's like I said, jumped from a toy to collectible to an investment, an asset, and maybe now to geopolitical currency. Well, legal tender, right? So it's the same Bitcoin, it's the same software, but it makes a jump in its physical assets, and so. Yeah, I think that's very, very interesting. And there is a very fundamental dilemma or discussion with central banks to be had here. Because if you imagine a small country like El Salvador making the step to adopt Bitcoin as legal tender, it shuts the door to the IMF. Because that normally a country like El Salvador would get a loan from the IMF, and the IMF would have some criteria that El Salvador has to fulfill, and then it gets the loan and blah blah blah. So, but right now, of course, it's sort of fighting the IMF, or IMF is not happy, and it opens some discussion. And for me personally, having talked to central banks and having worked with central banks a lot, there is a very fundamental thing about, on the one hand, Bitcoin being the best currency that there is, because it's absolute scarcity, because of its portability, because nobody can debase it, etc., etc. And the other story that central banks believe in, that a currency has to be controlled and has to be, you have to, like the Fed, be able to print money and to taper and to steer and control the economy. You have to accommodate when the economy needs it, and you have to tighten things up if it's possible. And I guess that control they're not going to give up unless they see that the absolute scarcity and the non-control will bring more benefits to the world, and that very and I'm not sure if I say that right, but that very fundamental, I see that very fundamental difference in view between central bankers that just don't see Bitcoin as money because it cannot be printed, and Bitcoiners see it as the perfect money because the same argument, it cannot be printed. So yeah, we have to discuss that, and but the geopolitical phase is, I guess, the ultimate phase, and very much looking forward to that phase.
Yeah, I feel like this gets framed a lot in a pretty negative context, but I'm a big believer in people. I think maybe it feels pretty divided, at least in the US right now, but I don't think people are as different as it's being made out to be right now. I have a very optimistic view of the future, and I think if you also go back in history and look, we've actually done a pretty good job of wresting control from governments, or just putting helpful checks and balances in there, right? Like you would look at something like the idea of separation of church and state as being, you take that for granted living in the US today, but that was like a huge struggle that had to take place over like 100 years or something like that. And maybe there's some happy middle ground, right? Where, maybe we're looking at the end of one way of how money is looked at through governments, and we say, hey, maybe this isn't really working. There are huge problems with it, and Bitcoin can be a big part of the solution, or the check and balance, right? So I think there are a lot of ways that this can all play out in general, but I would say I'm pretty optimistic about the future. Guys, we've already gone over the time that we had allotted for this. This has been a super interesting discussion for me. I had a bunch of questions that I didn't get to ask either of you, but thank you so much for coming on. If folks want to find out more about you or your work, what's the best way to do that?
Thank you, guys. I would love to talk for a couple more hours in the future. I could do this all day, you know. So, but no, thanks for having us. And people that that don't know my Twitter account, it's PlanB at 100 trillion USD. That's 100 trillion USD.
Thank you equally, and an honor to meet you, Plan B. Mike and I already know each other, but I'm at Timur Fidelity. That's where you can see all my charts.
Yeah. Guys, and just for folks, listeners of the show, I'm sure you probably know Jurrien's been on the show. I'd be shocked if you didn't know Plan B, but definitely go follow them. They put out a lot of great information. I've learned a lot. Guys, thanks again so much for coming on the show. We'll have to do it again sometime soon.